Hi, my name is Mohamad Aniq Bin Johari. I will present about the capital structure. First is, what is capital structure? A company capital structure is the specific mix of debt and equity is employed to fund its overall operation and growth. Equity capital is derived from a company ownership shares as well as claim on future cash flow and earnings. Bonds and loans are example of debt, while ordinary stock, preferred stock, and retained earnings are example of equity. Short-term debt is included in the capital structure as well. Next is how to determine optimal capital structure. As a rule, the optimal capital structure of a company is defined as the balance of the debt and equity that result in the firm weighted average cost of capital (WACC) being the lowest possible. In reality, however, this technical definition is not always followed, and organizations often have a strategic or philosophical vision of what the ideal structure should look like. Because determining the appropriate capital structure may be challenging, managers often seek to operate within a range of values. To minimize dilution and to avoid giving any negative signals to the market, a firm with promising prospects will prefer to obtain financing using debt rather than shares. Debt signaling refers to the practice of announcing a company's intention to take on more debt. The cost of debt, preferred stock, and ordinary share will increase if a firm raises too much capital in a short period of time. As a result, the marginal cost of capital will also rise. The amount of leverage employed by other businesses in the same industry is also compared, with this premise being that these businesses are operating with an optimal capital structure. To determine whether the company is employing an unusually high level of debt within its capital structure. Debt to equity ratio may also be determined by thinking like a bank. Why do banks lend so much money to many people? Other debt ratio may also be used by an analysis to provide a bond rating to the corporation. Next is factor effect capital structure and capital structure decision. First is size of business. Obtaining long-term financing for small enterprise is quite challenging. A long-term loan is only possible if it's agreed to ridiculous terms and high interest rate. Small businesses are unable to adapt their financial structure to their needs because of this tight limitation. As a result, small enterprises depend on retained profit and share capital to cover their long-term funding needed. Small businesses have a higher cost of obtaining long-term capital than big business. Second is stability of earnings. The amount of leverage is influenced by the sale and the stability of revenue. Companies with consistent revenue and sales may afford to borrow more money and utilize it to expand their capital structure. They are able to effortlessly meet their established financial obligation. Consumer product manufacturing business have a greater volatility in revenues and, as a result, employ a smaller amount of debt. On the other hand, the revenue and sale of public utility organizations are more predictable. Therefore, they can take on more debt in order to fund their investment. Next is stage of life cycle. Capital structure is also influenced by the company stage in its life cycle. They are increased out of a company failing if it is in infancy. They should be focused on using ordinary share capital in this situation. If a company does not issue fixed interest securities, it may operate normally. The risk is considerable. When a company is growing, it should design its financial structure so that it may acquire funds when needed. As a company matures, it must invest more in new product development, necessitating cash from regular shareholders due to the unpredictability of future revenue growth. Lastly is state of capital market. It is important to consider market trends when deciding on a company capital structure, since they influence the cost of capital and the availability of cash from various sources. Investors may be reluctant to put money into a firm that wishes to issue common shares because of the considerable risk involved. In such a case, The firm should avoid issuing shares and instead obtain sufficient capital via alternative means. As a result, the timing of a company public security issue is critical in determining its capital structure. Next is financial distress. What is financial distress? Financial distress is a word that is often used in corporate finance to describe any circumstance in which an individual or company financial state causes them to be unable to pay their expenses, particularly loan payments that are due to the creditors. Financial difficulty that is severe and sustained may finally result in bankruptcy. Financial distress must be addressed immediately in order to prevent the problem from worsening further. If financial difficulties are not quickly resolved, they might lead to even more financial difficulties. For example, if an individual or corporation is experiencing financial difficulty, their credit rating may suffer. The lender will change their higher interest rate as a result, making it more difficult for them to borrow extra funds to help them handle a period of lower income or revenue. There are some causes of financial distress, which is loss or reduced income, unexpected expenses, divorce, and bad money management. Next is the integration of tax effects and financial cost distress. Financial distress costs refer to the expense of financial crisis situation in which a business is unable to repay its debts and commitments. Costs linked with financial difficulty include indirect fees, conflict of interest, bankruptcy costs, and a higher cost of capital. Debt financing is a frequent practice in today's business world. Short-term or long-term debt can be used to finance an organization's activities. Debt finance has a significant impact on the economy. In light of the current cost of the bare minimum of discomfort, the likelihood of a crisis is slim here. The present value of this expenditure rises with each 1% increase in the debt value. It will eventually match the present value of the tax shield growth. The tax shield will lead to a quick increase in bankruptcy, which will lower the value of the company. See the graph that show how tax effect and financial hardship costs are incorporated into a single graph. According to the graph, if the present value of financial distress costs increase, the present value of tax shield on debt also increase in response, as can be seen in the chart. The integration of the two become clearer as a result of this understanding. Next is adjacent cost of equity. The adjacent cost of equity arises because of the difference in interest between the shareholders and the management. As long as the management interests diverge from those of the shareholders will be forced to pay the burden of this expense. Management may be inclined to make suboptimal decisions that do not contribute to the maximization of the firm's worth in the long run. It is inevitable that any procedures used to monitor and avoid this will have a financial cost connected with them. In this case, the cost incurred by the agency will include both the cost incurred as a result of the suboptimal decision and the cost incurred in monitoring management to prevent them from making such judgment. The second last that I will discuss is pecking order theory. The principle of asymmetric information serves as the foundation for the pecking order theory. Asymmetric information, also known as information failure, occurs when one party holds more which is better knowledge than another party, resulting in an imbalance in transaction power between the two parties involved. Management often has more information about the company performance, prospect, risk, and future outlook than external users such as creditors, which is debt holders, investors, and other financial advisors, shareholders. Therefore, external users want a higher rate of return in order to compensate for knowledge asymmetry and to offset the risk that they are taking by using the service. Pecking order theory explains why return earning financing with each internal financing is preferable than external financing. Internal finance as opposed to internal financing such as debt or equity financing. It's the most cost-effective and convenient type of funding. External funding, which is debt or equity, require a higher return since creditors and investors have less information about the company than managers do, which is why they seek a higher rate of return. Managers favor debt financing over equity financing because the cost of debt is cheaper than the cost of stock. Lastly is signalist hypothesis. Signaling is the process of initiating a trading position based on insider knowledge. It occurs when an insider discloses material information about a company, triggering the purchase or sale of the company's stock by individuals who do not normally possess insider information. To outsiders, the insider's activity are interpreted as a market signal. Tracking insiders' shareholdings and trading position can yield market signals. Some of the company's most powerful people are considered insiders. They may have the authority to make decisions and have access to internal company information. The optimal capital structure for a corporation is one in which the marginal subsidy to debt equals the marginal cost of debt. Debt is seen as a signal of a company's value by investors. In the long term, a manager who takes on more debt than necessary in order to deceive investors will pay for it. So, that is all from me. Thank you, sir, for watching.